Thanks for tuning into this conversation with the management of Tata Steel. To my mind, the numbers were largely a bang on in line with what the Bloomberg estimates were. There were extraordinaries which led to the bottom line numbers showing a miss. But the commentary from the management, as I saw yesterday, was optimistic about what excuse me, optimistic about what happens in the quarters to come. Mr. TV Narendran joins in to talk about that and more. Mr. Narendran, thanks so much for joining in. Put the quarter into perspective. Most people are seeing it as a glass half full, that the worst of the pain is behind. How did you think about the quarter, and did were there one or two things that stood out for you?
Thanks, Neeraj, for having me on the show. I think we've always said that Q2 would be the worst quarter for India and Q3 would be the worst quarter for Europe. So that's precisely what has happened. Of course, there was these one-off things which also happened, which I should take you through. One is we are in the process of de-risking the pension exposure in UK. We've already ring-fenced the business from the pension funds, but we are also shifting the pension funds to insurance. And in that process, there are some deferred tax credits that we have, which gets adjusted. So a big part of the 2,500 crore loss that was reported is because of the pension fund adjustment. It's a non-cash thing, and it's the right thing to do because it structurally keeps us in a stronger place. The second thing which has happened is in Europe, the realizations in Q4 are about 160 pounds per ton. In Q3 are about 160 pounds per ton lower than Q2. We had built up stocks in Europe because we have a blast furnace relining coming up in the Q1 of next year. So we were building stocks for that. And obviously, those stocks were produced at a point in time when coal prices were high. And so as we were, as a matter of prudence, when you do the NRV adjustments, there was a hit. So because of which the cost in Europe in Q3 is about 31 pounds per ton higher than Q2, despite the fact that the coal prices were $90 per ton lower, iron ore was $20 per ton lower. So that was a one-off cost impact also, because of which Europe went into negative EBITDA. But having said that, obviously we are not out of the woods yet this quarter. We expect things to improve, but not improve as much as we would like it to. We are still working on multiple options. The good news is in Europe, the steel prices have started going up. The gas prices have started dropping. Energy costs have started dropping. So I believe the worst is behind us, but we are still not out of the woods.
Actually, on that, while everybody, but and I'm just saying that I will also ask you about the normal raw material cost pressures, but just a word on gas, because there's so much commentary I hear about how Europe, from a place of deficit of gas, might actually be in a surplus area of gas simply because of all the provisions made and the fact that it was a warmer winter, so on and so forth. Do you reckon the trouble that gas prices in particular caused for a better part of the last 3 months are behind you for the calendar?
Yes, I think so. Because, the big concern in Europe was all the infrastructure for gas had been built assuming the gas will flow from Russia. So they did not, for instance, have enough LNG infrastructure. Some countries did, some countries didn't. So that's why there was a spiking in gas prices. And in many ways, it impacted us because when gas prices went up, many coal-based power plants came back in Europe, because of which thermal coal prices went up. Coking coal prices had anyway gone up. So, you had this impact. So, but as Europe and all the countries in Europe worked on two things. One is they cut down the gas consumption. Everyone is encouraged to cut down gas consumption. And secondly, they improved storage and they developed options, floating terminals, etc. So because of all that, the winter was not as bad, not only climate-wise, but also in terms of gas supplies. And hence you're seeing the gas prices settle to the levels which you have seen pre the Ukraine situation. So gas prices went up almost 5-6 times, right? So I think the worst is behind us as far as gas prices are concerned in Europe.
So if I ask you to kind of foresee, and I know it's a difficult thing to do in such scenario, but still, there's some bit of a correction in prices, even though there might be an uptick. At the same time, there's a correction in the input costs as well, and therefore the spreads, so on and so forth, and realization versus spreads. How do you think the next couple of quarters shape up? I would ask you for the year because it's too long a time frame in these circumstances, I guess.
Yeah. So Neeraj, I'll explain it this way. Traditionally, the carbon cost, energy cost was 10% of our raw material cost. Let me put it that way. So when you look at spreads, you look at iron ore and coal, and you look at steel price, and you look at the spread, right? So gas and carbon costs were, let's say, 10 to 20% of the raw material costs, and hence were not really material as far as the spread calculation is concerned. Over the last 2-3 quarters, it went up to 40%. So even if the spread looked good, a lot of it went away in paying gas prices, energy costs, carbon costs, etc. Today, it's come back to that 10 to 20% level. So it's back to where it was before. So we are no longer looking at the spreads not flowing through to the P&L because of this, right? So that is, to me, one way for us to explain it. Second way to explain it is, if I look at this whole year, we would have spent at least 100 million euros more than we would have normally done on energy and gas. Okay, this is despite some support coming from governments. This is despite some hedging being done by us, because we used to always hedge gas prices going forward. So we did not get hit by the worst, but still we have spent 100 million, and 100 million is a lot of money for us in the European business, right? So these are things that we will not have next year, right? So if we go back to coking coal prices and iron ore prices, they will also drop, because they had gone up to $600, right? So today coking coal is maybe around $340. It had gone down to $250, but it's also reflecting the recovery in China. Iron ore, which had gone down to $90, is back to about $120. So we always expect iron ore to be in the $110 to $140 range. Coking coal, normally we would expect to be around $300 on an average, unless there are spikes, there are weather events in Australia, or the kind of event which happened in Ukraine.
Got it. So just wondering, do you see some of these benefits of the cost savings being back-ended if I take the calendar into consideration, or could it be evenly spread out? Just thinking
so there are two things, Neeraj, here. One is a cost situation will keep getting better in Europe, like I said, because gas and energy will come back to long-term levels. Coking coal will go up and down, but a little bit of volatility we are used to handling. So I think it will be stable in that range, maybe $250 to $350 range. Iron ore will be in the $110 to $140 range. We are waiting to see whether the demand picks up, and demand could pick up if China opens up, because Europe exports a lot into China, particularly large economies like Germany, Italy, etc. Right? So that is something we are watching. On the revenue side, the spot prices will go up, but the long-term contract prices, which we just negotiated for this year, will be lower than last year, because last year's negotiations happened last year in January, and most of the long-term contracts were over 1,000 euros a ton. This time will be maybe 850 euros a ton or whatever. It will still be higher than the spot prices, but lower than last year's long-term contract prices. So we see a mix of this. For us, we also have a blast furnace relining coming up in Netherlands next year. So for 4 months, one of our blast furnaces will be down. But that's one of the reasons why we build stocks, so that we don't lose much sales, even though one of the blast furnaces will be down. So we are going to have a challenging, like I said, the worst is behind us from, as I described, last quarter. But we will still have a challenging quarter this quarter and the next quarter because of the blast furnace shutdown. But after that, we hope to get back to what we see as long-term performance levels.
Got it. I didn't see too many material differences in the I mean, from what you guided when it comes to capex or net debt reductions. In fact, net debt seems stable. So no great changes there. I reckon.
Not this quarter, but for our goal is always to reduce net debt by at least $1 billion a year. We did better than that in the last few years. This year was obviously a challenging year because of multiple reasons, including a lot of capital getting sucked into working capital because of higher coal prices. So we continue with our commitment, and next year certainly we look to reducing our net debt by at least $1 billion.
Got it. My final question, really, when we met at Davos. And I know things don't change so soon in the minds of industry leaders, but I'm still asking you. You had back then told me that you don't foresee a fully opened up China to lead to a kind of situation wherein it exports as it used to in 2015-16. Yeah. Now, the China opener, the pace has been very surprising for most watchers. Has that surprised you, part one? Could demand out there surprise, and could exports from China surprise, or no big surprises there?
No. I think if I were to answer your last part, I see, to me, the biggest test of Chinese exports was last year, when the Chinese economy was in bad shape, and they did not export anything which we couldn't handle. They exported 4-5 million tons a month, which is fine. The world can live with that. The problem we had in 2015 was they were exporting 10 million tons a month. So if in the worst period they did not increase their exports, I don't see them doing that when things are getting better. That is one. The second part is, I do see this year maybe China surprising in a positive way, because I think they seem to have got a grip on the property sector. Consumption is coming back in a big way, right? And they've certainly decided that there's no going back on that COVID restrictions that they had earlier. So I do see a little bit of consumption coming back in China the way it came back in India when India opened up on the COVID restrictions, right? And a lot of people traveling into China, a lot of people traveling out of China. So China could have a positive impact on on the world economy and on the steel industry this year.
Great. It's a busy day for you, so we'll leave you at that, Mr. Narendran. Thank you so much for taking the time out and speaking to us.
Thank you, Neeraj, for having me on the show. Thank you.
Pleasure was ours. Viewers, thanks for tuning in.
Thanks.
Thanks, sir. Take care.
Bye.